Hello and welcome to another video on Gap Advisors channel. Myself CA Manish CIA. The focus in this video is interest on credit impaired financial asset under Ind AS 109, commonly known as NPA. In this video we will discuss 1. What is credit impaired financial asset? 2. Requirements of Ind AS 109 on interest income on credit impaired financial asset. 3. Application of those requirements by an illustration. 4. Practices followed by listed NBFCs on interest income from credit impaired financial asset. And 5. Lastly, we will see the requirements of recently issued draft directions on asset classification, provisioning, and income recognition for banks by RBI, which are proposed to be effective from 1 April 2027. This video is going to be longer than previous videos. If you watch this video till the end, you will know 1. When a financial asset is considered as credit impaired or NPA as per Ind AS 109. 2. Whether interest income is recognized on credit impaired financial asset, and if yes, at what amount. Third, when a credit impaired financial asset can be said to be no longer credit impaired. 4. Whether interest is recognized on the financial asset that was previously credit impaired and is now not credit impaired, and if yes, at what amount. 5. Whether there is any unrecognized interest on credit impaired financial asset and how the same is recognized when received. 6. Practices followed by listed NBFCs. Here we will discuss accounting policies disclosed by 3 NBFCs in their financial statements for the year ended 31 March 2025. 7. Requirements in draft directions issued by RBI for banks on asset classification, provisioning, and income recognition relating to interest on credit impaired financial asset, that is NPA. And lastly, 8. Understand how the draft directions are different from Ind AS 109 requirements on interest on credit impaired financial asset. Before moving to the discussion, I would like to make it amply clear that the views expressed in this presentation or video are my personal views. The same are not binding on the viewer or listener. I do not accept responsibility for any action taken or not taken by any viewer or listener based on views expressed in this presentation or video. If you have any issues on Ind AS, you can submit the same on gapadvisors.com. If you would like to have one-on-one discussion with me on any issue on Ind AS or IFRS, you can book an online meeting from my page on TopMate. A link to my TopMate page is given in the description box below. In this slide, we will understand when a financial asset becomes credit impaired or NPA as per Ind AS 109. A credit impaired financial asset is one for which there is objective evidence of impairment. A financial asset that meets the definition of default is credit impaired financial asset. However, for a financial asset to be regarded as credit impaired, it need not meet the definition of default. Paragraph B 5.5.37 makes a rebuttable presumption of 90 days past due as the definition of default, which is same as prescribed by RBI for classification of any loan as NPA. However, under Ind AS 109, a company can have its own definition of default. Paragraph 35F of Ind AS 107 requires disclosure of definition of default, and if the company has rebutted the presumption of 90 days past due, the reasons for the rebuttal. A credit impaired financial asset shows clear evidence of significant decline in the borrower's ability to repay. Borrower default, bankruptcy, or severe financial difficulties are some of the indicators that the financial asset has become credit impaired. Paragraph 5.4.1 of Ind AS 109 requires a recognition of interest income by applying effective interest rate to the gross carrying amount of the financial asset, with an exception that if the financial asset becomes credit impaired subsequent to initial recognition, the interest income is recognized by applying effective interest rate to the amortized cost of the financial asset from a reporting period subsequent to the period in which the financial asset becomes credit impaired. To understand this requirement, we need to understand the following terms: gross carrying amount of the financial asset, amortized cost of the financial asset. Gross carrying amount of the financial asset is the principal amount lent plus the interest accrued on the amount outstanding minus any payments received from the borrower. For example, a NBFC lent a rupee 100 to Mr. A for 10% per annum, and a rupee 20 was received as payment from borrower. The gross carrying amount of the loan to Mr. A at the year end will be rupee 100 plus rupee 10 minus rupee 20 equal to rupee 90. Amortized cost of the financial asset is gross carrying amount of the financial asset minus expected credit loss allowance. For example, if the expected credit loss allowance on the loan to Mr. A at the year end was rupee 20, the amortized cost of the loan to Mr. A will be rupee 70. When the credit impaired financial asset is no longer credit impaired, the interest income is recognized by applying the effective interest rate to the gross carrying amount of the financial asset from a reporting period subsequent to the reporting period in which the financial asset was categorized as no longer credit impaired. It may be noted that presently RBI regulations do not permit interest income to be recognized on credit impaired financial asset or NPA. Further, as per RBI regulations, the unrecognized interest income when received is recognized as interest income. A question arises under Ind AS 109 how a company recognizes any unrecognized interest income when the credit impaired financial asset is no longer credit impaired. The unrecognized interest income is the difference between the interest income on gross carrying amount and the interest income on amortized cost. We will understand this by an illustration. A Limited has defined default as 90 days past due at the end of the reporting period, same as what Ind AS 109 presumes. A Limited has given loan of rupee 100 to Mr. B with the terms shown on the screen. There being no transaction cost, the EIR for the loan is the same as contractual rate, that is 10%. As the installments are monthly, the monthly interest rate comes to 0.8333%. EMI for this loan is rupee 2.12. Mr. B has paid the first monthly installment on time. Subsequently, Mr. B has paid lump sum of rupee 16.96 in the month of December. Afterwards, Mr. B has paid the EMI every month. A Limited reports quarterly. This slide shows the journal entries to record interest income and installment received from Mr. B during the quarter ended 30th June 2025. The loan is measured at the amount lent initially, which is the gross carrying amount of the loan, on 1 April 2025. Subsequently, interest on the amount lent is accrued at the monthly EIR of 0.8333% every month, and cash payments received from Mr. B reduces the gross carrying amount of the loan. This slide shows the position of the loan as on 30th June 2025. The loan is more than 30 days past due. Therefore, there is significant increase in credit risk of the loan. The loan is categorized in stage 2 and expected credit loss on the loan is recognized on lifetime basis. Impairment loss is recognized to the extent of ECL allowance at the end of the quarter. As the loan is not credit impaired, A Limited shall continue to recognize interest income on gross carrying amount of the loan. The gross carrying amount of the loan comes to rupee 100.36. ECL allowance is assumed at rupee 50, giving amortized cost of rupee 50.36. A Limited has incurred loss of rupee 47.52 for the quarter on the loan to Mr. B. A Limited continues recognizing interest income on the gross carrying amount of the loan during the quarter ended 30th September 2025. No amount is received from Mr. B during the quarter ended 30th September 2025. This slide shows the position of the loan as on 30th September 2025. The loan is more than 90 days past due. Therefore, the loan is categorized as credit impaired loan or NPA. A Limited will have to recognize interest income on the loan subsequently at amortized cost. There is an increase in lifetime ECL of rupee 14.58. Rupee 0.42 increase in ECL is the effect of unwinding of discount. Please note that ECL is the present value of the cash shortfalls discounted at original effective interest rate. Impairment loss is recognized for the total increase in ECL of rupee 15. The gross carrying amount of the loan is rupee 102.89. ECL allowance is rupee 65, giving amortized cost of rupee 37.89. A Limited has incurred loss of rupee 12.47 for the quarter ended 30th September 2025. A Limited accrues interest at the effective interest rate on gross carrying amount of the loan. This accrual cannot be avoided because of the effect of unwinding of discount on gross carrying amount of the loan. What can be avoided is a recognition of the effect of unwinding of discount on as interest income. Interest income is recognized only to the extent of the accrued interest at the effective interest rate on amortized cost. The difference is the increase in ECL, expected credit loss allowance, which is the effect of unwinding of discount on ECL. It may be noted that no suspense account is to be created for the difference of interest income between gross carrying amount of the loan and amortized cost of the loan. Mr. B has paid lump sum amount of rupee 16.96 in the month of December, which reduces the gross carrying amount of the loan and also the amortized cost of the loan. This slide shows the position on 31 December 2025. Loan to Mr. B is no more credit impaired. Therefore, A Limited shall resume recognition of interest income on gross carrying amount of the loan from 1 January 2026. The gross carrying amount of the loan is rupee 88.52. ECL allowance is rupee 66.63, giving amortized cost of rupee 21.89. A Limited has earned profit for the first time on the loan to Mr. B of rupee 0.96 for the quarter ended 31 December 2025. A Limited recognizes interest income on gross carrying amount of the loan and reduces the same by cash payments received from Mr. B during the quarter ended 31 March 2026. This slide shows the position on 31 March 2026. This is also the financial year end date of A Limited. Gross carrying amount of the loan has reduced to rupee 84.35. ECL allowance will increase by rupee 1.68 for the effect of unwinding of discount and reduced by rupee 18.31 due to reduction in estimated present value cash shortfalls. Accordingly, ECL allowance is rupee 50, giving amortized cost of rupee 34.35. The overall reduction in ECL of rupee 16.63 is recognized as impairment gain in profit or loss. It may be noted that the impairment gain is not presented as other income but as a reversal of impairment loss in the same line item in which the impairment loss was presented. A Limited has earned profit for the quarter ended 31 March 2026 of rupee 18.82. It may be noted that the unrecognized interest, that is the difference between interest income on gross carrying amount of the loan and interest income on amortized cost of the loan, is not recognized as interest income when received from borrower. This slide shows the extract of balance sheet of A Limited for each of the quarters in the financial year ended on 31 March 2026. This slide shows the extract of profit or loss for each of the quarters and for the year ended 31 March 2026. Having understood the accounting mechanics of interest income on a financial asset when it becomes credit impaired and when it is no longer credit impaired as per Ind AS 109. Let us see how listed NBFCs are accounting for the same. For this purpose, we had a look at the accounting policy on interest income disclosed by 3 listed NBFCs. REC Limited has received Financial Reporting Excellence Award from the Institute of Chartered Accountants of India. Hence, we first had a look at the policy disclosed by REC Limited. REC Limited has disclosed that it does not accrue interest on credit impaired financial asset under the pretense of prudence. This is not in accordance with paragraph 5.4.1 of Ind AS 109. Ind AS 109 requires interest recognition on amortized cost. Ind AS 109 does not provide an option to recognize interest income as and when received on credit impaired financial asset. Attention of the viewers is drawn to the requirements of paragraph 7 of Ind AS 8 accounting policies, changes in accounting estimates and errors, which states as follows. Start quote. When an Ind AS specifically applies to a transaction, other event or condition, the accounting policy or policies applied to that item shall be determined by applying the Ind AS. End quote. Paragraph 7 of Ind AS 8 makes it amply clear that income recognition cannot be postponed under the guise of prudence, where recognition criteria are met. It is not only a question of income recognition but also a question of presentation of the difference between interest income on gross carrying amount of the loan and interest income on amortized cost of the loan when received. REC Limited would be presenting the difference as interest income, whereas the principles of Ind AS 109 requires presenting the difference as impairment gain. This is because REC would look at the difference as unrecognized interest income, whereas Ind AS 109 considers the amount received as a recovery of ECL allowance. Bajaj Finance Limited has disclosed that it recognizes interest income by applying EIR to the gross carrying amount of the financial assets other than credit impaired assets. The company has not disclosed how it recognizes income on credit impaired financial assets. This could be because Ind AS 109 does not provide any choices for recognizing interest income on credit impaired financial assets. Accordingly, the company could have made an informed decision that disclosure of interest income on credit impaired financial asset does not meet the conditions for disclosing as material accounting policy. Shriram Finance Limited has disclosed that interest income on credit impaired financial assets is recognized by applying the EIR to the net amortized cost of the financial asset. Appendix A of Ind AS 109 contains a definition of amortized cost of financial asset or financial liability, where it is explained that amortized cost is equal to gross carrying amount of the financial asset minus ECL allowance. Therefore, using the word net as a prefix to amortized cost in the policy makes the policy confusing and vague. The reader of financial statements is assumed to have a reasonable knowledge of Ind AS. Accounting policy disclosure is not an education document. The companies are recommended to remove the word net appearing before amortized cost from its policy. GAAP advisors can help you to get rid of mistakes by reviewing your financial statements. For review by GAAP advisors, please mail your financial statements in PDF to info@gapadvisors.com. RBI has issued draft directions on asset classification, provisioning, and income recognition for banks. The draft directions propose to move towards interest income recognition on effective interest method and provisioning as per expected credit loss similar to Ind AS 109. The new directions are proposed to be effective from 1 April 2027. Paragraph 83 of the draft directions contain the requirements on interest income recognition on credit impaired financial asset. Para 83 also requires interest income to be recognized on amortized cost of the financial asset in a reporting period subsequent to the reporting period in which the financial asset was identified as credit impaired. This is similar to Ind AS 109. However, Para 84 of the draft directions requires the amount of interest revenue accrued on credit impaired financial asset as per Para 83 to be debited to P&L and as an additional ECL provision. This slide applies the RBI draft directions to the illustration discussed above. It shows the journal entries that would be recorded in the quarter ended 31 December 2025 if the company were to follow RBI draft directions. It can be seen that the RBI draft directions result in no profit, no loss during the quarter ended 31 December 2025, whereas as per Ind AS 109, there was profit of 0.96. Also, the draft directions ignore the basic concept that gross carrying amount is the present value of the cash flows of the loan and ECL allowance is the present value of the expected cash shortfalls. This slide shows the position as on 31 December 2025 applying paragraphs 83 and 84 of RBI draft directions. Paragraph 85 of the draft directions also required bank to resume recognizing interest on gross carrying amount from reporting periods subsequent to the period in which the financial asset was no longer credit impaired. This slide shows the journal entries applying paragraph 85 of RBI draft directions. For this purpose, we have considered the position as on 31 December 2025 applying RBI draft directions given in slide 21. This slide shows the position as on 31 March 2026 applying paragraph 83 to 85 of RBI draft directions. This slide shows a quarterly balance sheet as per RBI draft directions for the loan to Mr. B. This slide shows a quarterly statement of profit and loss for the period and for the year ended 31 March 2026 as per RBI draft directions for the loan to Mr. B. Thank you so much for watching this video till the end. Join our mission to spread knowledge and awareness of Ind AS by liking and sharing this video. Please subscribe to Gap Advisors channel if not already subscribed.